Okay, we're looking at profit and loss now, and especially profit and loss, how it relates to a business within a business context. Now, when you run a business, basically what you want to do is you want to generate some revenue, which is income, and you want your revenue to be more than your expenses. So in a company, you want more money coming in than you want going out. So that makes sense. You want to be able to make a profit. So in this course, we want to look at what is revenue and what constitutes revenue, what constitutes expenses, and then work out a way of working out how profitable a company is. So a profit and loss statement is a written record of what's going on and helps businesses keep track of their finances and calculate their annual profitability. Now, in terms of revenue, we basically look at things like sales, which is if you're selling an item or a good, that's the money. You might get paid some fees, and that might be called services rendered. So going and mowing a lawn for Jim's Mowing, you get paid for doing that. That is a service, and therefore you get paid for it. And commissions, interest received from the bank, dividends, and you might have a whole lot of properties that you're renting out, and you'll get an income from them. That's revenue as well. Now, expenses, we keep them fairly simple. We have wages, which is your biggest expense, rent if you're renting premises, insurance, rates and taxes, advertising and promotion, and another one which is quite important is depreciation. So you might have, if you've got a lawnmower around, a whole lot of machines, as they wear down, that's called depreciation, and you will have to pay for that, so that becomes an expense. So that's got to be included in a profit and loss statement as well. The only thing you've got to kind of keep in the back of your head is that a capital item is not included in a profit and loss statement at all. So that's something like a car, a vehicle, or maybe a building. They are not included in a profit and loss statement. Even though they assist a company, they don't actually bring direct revenue to the company. So therefore they're not counted in a profit and loss statement. The depreciation of those items can be, but not the actual capital items themselves. So let's have a look at a simple kind of profit and loss statement and go through how you set it out, because it's quite a specific way of doing it. So we read through all of this and we find out that we've got some income in these lots, and the rest down here is all expenses. So if we add those income bits together, take the expenses out, we will get whether we've made a profit or a loss. Now, it's not that simple. We've got to set it out in a certain way. So what we do is we go and set it out like this. We get a heading, which needs to be written out. You need to tell us what the company is and the year or the date when you're doing the profit and loss statement. Then we do revenue first and expenses second. Okay, so it's always done revenue first, expenses second. So in R1, we've got two lots of revenue, which we add together, and then we write over here on the right hand side of the page. So we have $546,560 in revenue. Then in the expenses, we list them all down. So you go through the question, you write them out, then you write down every numerical value that you've got, and then you add them up down the bottom here. Now, make sure that you do your adding up properly and you check your answers and those kind of things. Then this comes across here and becomes a negative number or an expense, because what happens is you're taking that away from your income. Notice that we put it in brackets. Brackets indicates that it's going to be taken away. So then you go 546, take away 325, and you get a grand total of 220,781. So that is actually how much profit you make overall. If the question said discuss the profitability of the company, or how could you actually look at making it a better company, you'd have to look at this factor here, which is your wages, because your wages is over half of what you're bringing in. So maybe as a business you can look at those things to try to make improvements. Okay, very simple profit and loss statement. What this doesn't take into account is that if you're selling stuff in your shop, you've bought a whole lot of things. So make out you're selling tellies. You bought a whole lot of tellies for your television shop, you've paid for them, and they're sitting on your shelves. You might buy some more during the year to add to the stock that you've got in your shelves, sell a few as you go, and at the end of the year you've still got some stock sitting on your shelves. Now you have paid for that stock, so the costs of the goods that you have there has to be taken into account, and it's called cost of goods sold. So there's a procedure that we follow through, but let's explain kind of what it does in real life. So this is our shop. Okay, you just got to kind of imagine this with me. What we've done is, above this wiggly line is what we started at the beginning of the year. So we've got these many items sitting in our shop. So we've already spent the money on this, and that's $350 worth of items. During the year, we buy these ones. We add to the stock on our shelves, which gives us another $430 worth of gear. So this is what we call our opening stock. Okay, we then have got some purchases, so we add them in together. So we have a grand total of $780 worth of goods that are available to be sold. So this is how much we've already forked out of our pocket, and that's what's sitting on our shelves in our shop. However, let's just think, okay, what happens is people come in and buy some items. So let's pretend that they buy all these things here. Okay, now I'm just kind of making up. So they've all gone. So these things here are left in our shop. Okay, and that's what we call our goods, our closing stock. Okay, our closing stock. So this is how much stuff we've still got sitting on our shelves at the end of the year. And when we do that, we've still got $450 worth of gear sitting there. So if we get this number here, which is how much we have at the beginning of the year for sale, take away our closing stock, we'll end up with a grand total of $330 worth of gear. That is the cost of goods sold. So this is an expense in there. So you've got your opening stock, you plus your purchases, you take away your closing stock, and you get how much money you've actually forked out on the items there. So if you remember those things, then it makes it quite simple when you come to a profit and loss statement that's got them in there. So let's have a look at your typical question. What you need to do is, going back to here, calculate the cost sold. You look at the stock at the beginning of the year, add in what you've purchased, and then take away what you've got left over. So let's have a bit of a really simple look at one. You've got a shop that has a stock value of $220. So this is the beginning of the year. And then during the year they buy another $278. And at the end of the year they count up and realise that they've got $189 left over. So your opening stock is $220. You've purchased another $278 worth. So sitting on your shelves is $498,000 worth of gear. At the end of the year, the closing stock that you've got sitting on your shelf is $189,000. So that gives you a grand total of $309,000, which is your cost of goods sold. So this is actually an expense. So this whole thing here has to be incorporated within a profit and loss statement. So you might be thinking, oh crikey, that's going to get a bit tricky to do. But let's have a look at a typical question and then go through how we set it out. So that's just explaining the fact that we need to take out the cost of goods sold from what we've got. So let's have a look. You've got a profit and loss statement for Fred's shop, and he's got the expenses and revenue for the year. So once again, we've got to read through it. And the only difference between this one and the other one is that we have something like opening stock. Okay, then we've got our purchases, and then we've got our closing stock, which means that we have to do one of those ones that has the cost of goods sold in it. Okay, so we've got to be able to have a cost of goods sold section in our profit and loss statement. So don't panic. The first thing you're going to do is read the question, to work out the cost of goods sold stuff and maybe even underline that. Then I would nearly go, what's a revenue and an expense? So we've got a revenue from sales. Is there anything else that's going to give us out of this one that gives us any sort of revenue? I reckon there's not. I reckon that's it. So then identify revenue and expenses. So once you've done that, then you can go ahead and do a profit and loss statement. So let's have a look and see how that looks. Once again, we start and we have a profit and loss statement. We then go for our sales, which is $885,000. We have opening stock of $138. We have purchases of $99,000 100,200, which means our goods available for sale is 237,200. Closing stock is 116,590. You take them away and you have 120,610 is our cost of goods sold in here. And then when we take that away, we get a gross profit of 764,390. So that's how much we've made without our expenses. So then what we do is we list off all our expenses like we have before. They just scroll down like that. We add them up, and then as we did with the other one, that comes across to here as a negative number. So then this one, subtract that one, gives us this one here, and then this number here, subtract that one, should tell us whether we've got a net profit or a net loss. And when we do that, we have a net profit of $622.687. So it's the same process and the same procedure for each time we do this. So it's really important that when we do this, we follow the same process. You have the cost of goods sold to start with, then you have your expenses there, and then you have your findings down the bottom there. Notice how we've got clear columns where everything is, and it makes it easier to follow. So that's how we do a profit and loss statement with cost of goods sold in it, which you'll need to be able to do.